Okay, here's another one of my classic cell phone camera videos. This is my style. It's way too quick. I'm not tech savvy. I am not going to get fancy with these videos. But here's how to use that market price action thing with the spreadsheet. So all the spreadsheet is a bunch of check boxes that weighs things at various strengths to tell you kind of how bullish or bearish things typically are. And that gives you an objective measurement of what to expect from the trend. So you can take a look at how SPY is moving somewhere and how strong that movement is. And then you go, okay, well, there might be a bear trend, but I don't trust it because there's a lot of evidence of bullishness in it, or vice versa. And that helps you anticipate stuff. So what the checkbox doesn't do is it doesn't tell you where SPY is going to go. Okay, so that's going to be on you to figure out. You're going to have to use resistance points, support points, higher time frames, the context of the market, all of those things. But this will help you objectively look at the price action and see if what you think is going to happen is unfolding. Okay, so first one is the direction that things are moving in. So obviously, the direction that things are moving in is the most important thing. So is the price going up or is the price going down? And you'd be surprised at how many of us forget that because we go, oh, it's supposed to go up, so we don't look at it going up or we don't look at it going down. But you have to look at that. The next thing is the pivot points. So are there lower lows or higher highs, right? So here's a high, and then here's the next high. That is a lower high, right? But then we look at this high, and then that high, that's a higher high. So keep that in mind as well. Lower lows, higher highs. First two things, basic technical analysis, very straightforward. Now we take a look at the quality of the candles, the wicks. So let's say you're analyzing like this chunk right through here, and you're looking at all the wicks on the candles. What I like to do is I like to go, okay, is it more bottom wicky or top wicky? So look, we got a topping wick, topping wick, topping wick, and topping wicks are more bearish, bottoming wicks are more bullish. And you can take a look at these and you can add them all up. So I go, okay, if I look at all the bottom wicks and I added up all those little wick lengths together into one giant summed up wick, would that wick be bigger than the amount of top wicks? So is there more bottom wickage versus top wickage? That's the easiest way to kind of mark that. Sometimes there's neither, so I don't check either. But if there's more bottom wickage, then I check the bottom wickage one. After that, what we're looking at is HA candles. So with HA candles, the easiest way on the HA candles is just to look at the last three in a row. So there's doji candles, there's flat tops, flat bottoms. Flat bottoms are bullish, flat tops are bearish. I look at three in a row. If there's three in a row, that shows that things are pretty damn trendy. And the HA candle is basically just a bunch of math that adds up the highs and the lows and stuff and tells you generally how trendy things are, and you can see through the chop. So the last three in a row. So right on market open, we got bam, bam, bam. Well, actually, we got five in a row right here. So I would check that off as the last five in a row are HA candles. So things are looking kind of bullish. But then we get boom, boom, boom. This one is not quite one because you can see that little baby top wick through there. But I would still count that. So then I would switch that off this one and I would put it on to the bullish, the bearish side for the three in a row. But then we get over here and then we got a little pop, pop, pop right through there. Now all of a sudden the last three HA candles in a row were green. So as you can see, this thing fluctuates and changes as each candle unfolds, and it will help you see objectively what the price action is telling you, so what you should expect, right? So if something's getting somewhere, but it's getting there in like kind of a crappy sort of maybe wish-washy sort of way, as it's approaching a big line of support or resistance, you might be more inclined to believe that it's going to bounce off that line versus punch through it. But if it's going there with a really convictious sort of way with a high score, you can be more inclined to think, okay, I'm going to give things a chance to punch through. So that's an example. Let's move on to the next thing. So now we're looking at long green candles or long red candles. Long candles are very important. Pete from Option Stalker talks about long candles all the time, and it's been very helpful. A long candle, especially with a lot of volume, tells you that things are aggressively trying to get somewhere. I would count this right here as a long candle. I would count these as long candles, but they're kind of wicky. I like really big, thick, long candles. This is the first big boy long candle right through here. Maybe this one right through there. But long candles are telling you something. But more importantly, not necessarily the candle itself, but the response to the candle. So for example, Look at this one. This is a nice boom, 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 really big aggressive move up, and it's got volume too. Pop, pop, pop. But you look at the response to it, and that bearish candle immediately just destroyed this whole long green candle right through here. So this green candle popped up, it claimed this price, but it could not defend the price. So when I'm looking at the last defended candle, let's say right through here, the response to this candle was nothing. And usually I use the halfway point of the big candle. So if the price action can't breach the halfway point of that candle in response to it, that means that this candle defended its price action, and that would be of note. So I would note that, whatever the last long candle defended was. Next, we got higher relative volume on candles. So if you look down here and you're going through the charts, you can take a look at the red volume candles versus the green volume, right? So green here is green candles, red here is red candles. Let's say we're looking at this like kind of wish-washy chunk right through here. Are there more red high volume candles or are there more green high volume candles? And I use the same idea as the wick. So if I were to add up all of the volumeness of this chunk right through here, and I took all of these little volume bars and I added them up and stacked them up over a certain period of time, which would be higher? Would the green bar be higher or would the red bar be higher? So I would say there's more red relative volume than green relative volume. Even though the whole thing is pretty damn low, I get hints. Look at that. That's a nice aggressive response. There's another one. Here's a big green one too. And then that's that 1, 2, 3. But then look at the response of the red one. It's almost a little bigger. It's exactly the same, right? So you look at the volume as like how convictious are these moves, and you can see these little hints of bearishness coming in the volume. That one right there is the game changer, and that's the one where it broke support. Okay, so the relative volume of the candles is a very good tell as well in the price action. Next one is 3 stacked candles. The 3 candle stack, and I would say this would kind of be one right through here. This one is a better one though. So stacked candles means candles with minimal overlap. There's usually like not a lot of wicks on them, and there's also not a lot of overlap on them. That is an aggressive move because on a higher time frame, that's a long candle, right? So a 3 stack is a big deal. And you want to make note of the last 3 stack. And you can also say like, hey, the midpoint of that 3 stack is probably that defense point as well. So you can mark that as well. Now, if you got like 3 HA candles in a row with a 3 stack and a lot of topping tails and tons of relative volume, well, that is bearish as hell, right? So even though it might not be moving the way you want it to move, you can tell in the price action that there are a ton of sellers rumbling below the surface. So the last one has to do with the 1OP indicator. If you use Option Stalker, you know a lot more about how that works, but the 1OP indicator basically just gives you a bead on the natural oscillation of buying and selling. It's pretty proprietary and we don't know exactly how it works, but it works about 75% of the time. Now, when there's a divergence, which basically means it's in like a bear cycle, so things should be kind of selling off, like it's a pullback in a bull trend, or it's like a big move down in a bear trend. If it didn't really do much, let's say we were in a bear cycle right through here, and you're like, oh, not much is really happening. And before that, we saw a lot of bullish price action. We know that the next time it crosses back into bull after like a weak, wimpy bear cycle. That's a divergence, and that's very, very strong. It basically means that during the selling cycle, barely anything really happened because the buyers were so strong. And now that we're back into the buying cycle, things are going to really take off. So if you're an option stalker and you have that, that's cool. That's how that works. But if you don't have it, don't worry. You can still use the price action to get a really good beat on things. Now, like I said before, this doesn't tell you where the price is going to go. It tells you how it's getting there. And that will give you clues about what it's going to do when it reaches these bigger, higher time frame points. So today on SPY, when you look at it, you can see a lot of mixed candles. You can see a lot of wickiness and a lot of bottom wicks. You can see that the volume isn't very convictious. There's a whole lot of reasons for why going purely long or being very convictiously long might not be a good idea, but you still had to respect the fact that it gapped up. But as soon as you got this point right here that broke this support, basically all of that evidence or those clues like a detective started to show through, it's bear time, right? But you could have been anticipating this or seeing this as a possibility based on the price action unfolding. So hopefully that helps you. Your idea basically is to look at things candle by candle or every couple candles and continue updating the checkboxes on it and continuing to see how the bearishness and the bullishness unfolds in the price action. And then eventually all this becomes internalized in your head, so you don't actually have to use a checklist. You can just kind of objectively see it in your mind as it unfolds real time. That's the ultimate goal, is to be able to just dynamically do it, not manually do it. And that is what the criteria checklist is for.